My last pointer with respect to themes is valuations. And we've put this slide together, perfection ahead, because in our opinion, the US markets are to some extent valued with perfection. But there's a warning. The path will not be easy. We start with a slide of operating margins, profit margins in the US, all-time highs. Some would argue that that's normal when an economy develops. You move from producing widgets to producing IT products, and your margins are going to be higher. And we buy that. We understand that. But what the graph doesn't show is those margins are at the expense of labor. And labor now is demanding a bigger slice of the pie. Margins are high in the US, difficult to sustain that level of profitability. Our next graph is a little trickier, but what we show here is this S&P real earnings yield in blue against the S&P 500 index in red. And what we're trying to show in green is that bull markets always start when the earnings yield is high. And you see that in the green columns that we show. So if you want to take your chances and bet on a bull market, wait for the earnings yield to be at a high point. Contrary to that, bear markets and dead markets start when the earnings yield is low. And what we can see in 2022 is that the earnings yield in red on the far right of the graph is the lowest it's ever been. When we look at the cyclically adjusted multiple on the S&P 500 or the CAPE index, we can see that the markets are at all-time highs here, while interest rates are at all-time lows. Interest rates are not going down, they're going up. And that multiple requires excessive levels of profitability to sustain it. We see extreme valuations across many stocks in the US market. What we've then done is we've looked at the current PE or forward P on the S&P, and we've looked back historically and said, well, what kind of returns can an investor get off this kind of PE? And what we show is that an investor would get 5% annualized returns nominal. But if we think that inflation is going to be 2 to 3%, that means only a 2% real return annualized. And a rational investor would want 7 or 8% real from the markets. So we see low prospective returns coming out of the US market. But that overvaluation, fortunately, is not homogeneous. And what we show here is there are various markets, the Nikkei, the Chinese market, European markets, and emerging markets that are not nearly as overvalued as the US. A similar graph, just showing the emerging market average PE over time and how many markets trade below that. And I just take Brazil as an example. It's been a terrible underperformer. Its currency is devalued, the stock market has done terribly, but suddenly in the last 2 months there's been a boom in Brazil stocks. So there's action out there in cheap markets. What we show here is that emerging markets in red are the cheapest they've been against developed markets since 2004. So that's the good news about emerging markets. But here's the negative news. Emerging markets need to grow their GDP. And unless they do that in a more consistent way, there's no natural tailwinds for those markets to perform. And we've used South Africa as an example of terrible GDP growth over time, stuttering along. We've watched Sona and we watched the president try to address this. But unless we see more consistent GDP growth, South African market will be perceived more as a value play at times than a consistent perpetual performer. When we look at the South African market, the FINDI at the moment, and we look back to see what kind of returns you could get off the current PE, you're getting double-digit returns at least because the market remains relatively reasonably priced. Now, as we sum all that up in terms of asset class returns against a benchmark for each one of those asset classes, our benchmarks are in red. What a rational investor would expect from each one of those asset classes against our expected returns with all our modeling, which includes many of these themes that we're grappling with. And what we can see in a nutshell is that South African fixed income assets on the left-hand side of the screen generally meet their expected return hurdles. South African equities in the middle of the screen also meet their expected return hurdles. However, on the right-hand side are developed market assets, and they do not meet the expected return hurdles. That brings me into how our fund is currently positioned. As you would imagine, considering our view that South African equities remain cheap, last year we moved exposure out of offshore assets into South Africa. And now our local equity component of the fund is larger than our strategic benchmark. With respect to South African bonds, we did the same, selling global equities last year and put it into South African bonds yielding 10%. It was a no-brainer for us. The currency was undervalued, South African rand was undervalued, and bonds were dirt cheap against an expensive global market. And then on the right-hand side, we've gone underweight global equity, and we at-weight gold as an insurance policy against tough times. I'm going to conclude with this slide. And it shows on the x-axis, the horizontal axis, the amount of risk that managers take in funds in the balanced sector. On the y-axis or the vertical axis, it shows the returns we generate. The slide is a month old, but it's 36 months of data. And it's interesting in the following way. It represents a period of high risk-taking in markets, which is unsuited to our style. We're a relatively low-risk manager. However, we still gave the same return as the peer group over 3 years, but we did it at a fraction of the risk versus our peers. What is also important to note is there's some managers to the far right. They took big risk, but they got the returns, and good for them in a market that paid you to take that kind of risk. But we don't think the market suits that style going forward. And what we can say is this graph has actually changed over the last month. And the little dot, blue dot to the left of the red dot is our major competitor that we've been competing with for years. And we've now overtaken that particular competitor, giving higher returns with lower risk. And to us, those two managers, ourselves and that particular competitor, are well suited to the environment that we're going to see in the next few years. Trench warfare, tough markets, unsuited to managers taking excessive amounts of risk. So what we say, and as we conclude this presentation, is that our particular fund gives a lot of bang for the amount of buck or risk that we take. And we think that is an exceptionally good place for investors to hide in the years ahead. Thank you very much.